Well, the markets are closed today, but we're here. And I thought we might talk a little meat and potatoes and regional banks, which were the questions that we were being asked about last week. Today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. Last week, I was being asked about regional banks, Zions Bancorp, if memory serves more precisely, and also Lamb Weston. Lamb Weston, for those that don't know, they are in the potato business. So, hence the sort of conversation about meat and potatoes. And I actually have the company's financials up. I think I showed these briefly last week. I'm going to blow this up a little bit so we can take a closer look. And this is not one of the names that I would normally promote because, you know, from my perspective, if you're going to invest in equities, I'll just make this as big as I can. If you're going to invest in equities, which is fine, you know, once you start picking stocks, they have to get pretty interesting from a growth perspective, as far as I'm concerned, before you say, okay, I'm going to go reach out and buy this, largely because growth has it's almost like a magic bullet of sorts that if a company is really in a great spot, they have expanding margins, they have top line growth, eventually they will grow into themselves. There have been many times over the course of the last 10, 15 years when folks might have looked at NVIDIA and said, this thing looks expensive. They could have looked at Broadcom and said, this looks expensive. They could have looked at AMD and other companies in the space and said, this looks expensive. But they were in the hot space, and consequently, they grew into their valuations and then some. And that's not to say that you should chase every high growth stock. You shouldn't. What I am saying, though, is that, equities perform pretty well in general on a risk-adjusted basis, and most people's investments should contain them. When you're looking at your individual stock selections, though, it's usually because you find something particularly compelling about it. So we were asked about Lamb Weston, and, the potato business isn't exactly, the French fry business, not exactly a growth business. So why would one look at something like this when, if we're taking a look at the line that I've highlighted here, you will observe that the company has not been growing, and indeed, in real terms, is not growing at all. Because if you factor in GDP growth, and if you factor in inflation, and you see that for their fiscal year ends at the end of May, which is one of the reasons why if you're looking at these top columns, these dates up here, this is the end of their respective fiscal years. We can see that after 2024, 2025 definitely was negative growth in absolute terms, but on an inflation adjusted, GDP adjusted, however you want to do it, negative terms there. This fiscal year, which is going to be ending in May also, and next year too, right? So really no growth at all. So why would one invest in a business like this? And the answer is valuation, right? So really we're looking at this number right here. So just going out to next year, we'll just say that we think that they're going to make $3 a share, and that works out to about 14 times earnings. And the question you might ask yourself is, okay, do I want to buy a company at 14 times earnings that's not really growing? Well, if you happen to believe that it's not growing, but it's also not going to really shrink, then the answer to that would be, sure, why not? Now, I would also make one other quick point, which is that this is a business that carries a pretty decent amount of debt, about $4 billion in debt. And if we take a look at their free cash flow to enterprise value, we've seen a lot of these high growth companies, these things are generating 4 or 5% free cash flow yields, and they're growing free cash in the low double digits. So that is, free cash flow yield is definitely something that those of you who watch me regularly will know that I care about, because much like growth, cash flow solves a lot of problems. And the biggest and best companies have oodles of free cash flow. In this case, if we're just looking at free cash relative to the enterprise value, 4%, it's going to be slightly lower next year. So the free cash flow is not growing. But the valuation is reasonable, given its lack of growth. And it's probably a stable business. So if you're looking at a business like this, then you would say, okay, well, what am I hoping to get out of it? I guess that'd be kind of a reasonable question to ask. You're going to invest in something, you want returns. What kind of returns are you hoping to achieve? And I think that one of the things you would want to do in a name like this, because you're not going to see massive amounts of share price appreciation, is that this would probably this would be one of those stocks that you would look at as an overriding candidate to, collect some premium. And where would you potentially like to do that? Well, one way you could do that is just say, okay, well, this is probably a fairly range-bound stock over the long term, simply because it does not have particularly exciting growth prospects. And when the stock gets depressed on a relative basis, those might be circumstances where I would say, okay, I'm going to start selling cash-covered puts. And if the stock appreciates, I might start selling some upside calls or call spreads. Right now, I mean, the valuation is about as cheap as it has been in 10 years. I mean, it was a little bit cheaper in here. So this would probably be that moment when you would say, okay, well, I'll look to sell maybe some downside premium. What level might you be looking at it? $40 price to the downside, maybe sell some puts. So look to perhaps 30 delta puts or slightly below. For this exercise, I'll just pull up options play here. We'll take a quick peek and see what kind of yield one could achieve. Because this is really going to be about yield. This is not going to be a, set, forget, buy the stock and hope it knocks the cover off the ball, because it's not likely to do that. The valuation is reasonable given what's going on. Because of the leverage, the implied volatility and the volatility of the stock itself is slightly elevated. And maybe we'll go out 45 days or thereabouts. And actually, you're going to be selling puts, not buying them. That doesn't seem terribly compelling. I would look to try to get, I'd try to get a full dollar out of it, I have to say. So you might just throw a limit out there and see whether you can get a dollar for that one. Look, the objective here, you're taking an equity-like risk. That's 60 days, so a sixth. A dollar over 40, you're looking at 2.5% over 60 days. We want to get 12% annualized. That's pretty much, a way that you could sort of trade around this thing. Maybe I don't think does this have? Let's see what we have in terms of. I don't remember if this one has weeklies or not. Oh, it does. Okay. So actually, you don't have to go that far out. Could go out to the 27th of Feb. And you might be able to get these ones off, the 41s, at $1 if the stock pulls back a little bit more. So it might be worth just sort of sitting on the offer there. And if we're taking a look at potential catalysts, the good news here is that because the stock was so badly bruised when they announced their last earnings, probably not going to get a lot of new information creeping in. I will say that, Carter Worth often likes to look at circumstances like this where you have these big moves, and he likes to sell strangles around a stock when it has experienced a move like this. And there's a lot of sort of intuitive sense that makes if you think about it, which is that will you ever know more about a company than right after they report earnings? So you basically get to hear from management, see and hear what the results were. This is about as well informed as somebody without any kind of, special intelligence will be about a company. And the point that Carter often makes is that when this happens, the markets can be remarkably efficient at repricing the stock, and that a stock will gap to a new price based on that new information, and it will have a tendency to sit there. Now, what's interesting is that he will often take a look at doing something like this on or about, the second or third day. Take a look at where the stock landed right after that happened, and you will notice how tight the range has been in the stock since that time. And it's been within a $5 range, even less, closer to $4. So, I think that's sort of proving out the thesis that he has in circumstances like this. My only observation about that would be that I don't generally like selling naked upside on depressed stocks that are trading at, cheaper valuations. I don't, especially in a company that, I'm not saying this thing's going to get acquired or anything like that, but this is a circumstance where, you'd feel pretty bad about it, I think, if you had a naked short exposure to the upside at 15 times, forward earnings estimates. Not that you think it should be trading at 25 times, because it shouldn't. It's not a growth stock. It doesn't deserve a market multiple. But it's just a tough place to get net short. So I think that, if you were looking at Lamb Weston here and saying, okay, how can I earn a little bit of return out of this? My suggestion would be those late Feb weeklies. There isn't a catalyst on the board. Try to get $1 or so for the 41s. It's very close to that. About 93 cents, I think, is where it was as of Friday's close. Stock's a little bit soft here. Get those off for $1, and you're looking at maybe 15% annualized rates of return if you manage to get those off. Okay, so that's that. The second thing that I was asked about were the regional banks. So taking a look at the regionals, and we talked a little bit about this on Fast Money, actually, on Friday. I think, some of the worst news for the regionals is kind of behind us. And what was the worst news for the regionals? The worst news for the regionals was really, I would argue, the local commercial real estate picture. They had outsized exposure to that relative to the money center banks. It's an interesting thing when you consider what banks wear on their balance sheets. The big banks, I'm not going to say that they churn, but they underwrite securities, they sell securities and debt, and they always have a fairly big balance sheet, but they don't end up getting as much of that kind of really a local exposure that the regional banks will. So they're not going to have huge exposure to some local builders and local commercial real estate projects. I kind of feel like the worst of that is behind us at this point. And I have said on more than one occasion, Mark Guthner has also said, and others besides, people far smarter than I when it comes to this, that I imagine that we're going to have this sort of steeper term structure. Banks borrow short, they lend long, and that's generally in favor of them. Do I think that it's a huge growth story? Not necessarily, but I do think that it's probably an okay place to be. So, we can look at that if you don't want to be too specific about the individual issue. KRE, probably not a bad proxy for the regionals. And we can take a look at, where we're at here. It's had a bit of a run recently. This could be an intermediate top, perhaps right in this area right here. But maybe something like a call spread risky if you're in something like this where it's not going to have too much idiosyncratic risk. Wouldn't be a bad way to play that. You could probably do that with some of the single stocks as well. So let's just construct that one really quickly. Again, and this sort of goes to my earlier point too. When you don't hear me sort of initiate, these are questions that are being posed to me. You don't hear me sort of proactively saying, hey, I really think now's the time to get along the regional banks. I mean, my point is that I don't think of them as delivering huge outsized performance on a relative basis. But I also think that they're an okay investment, if that makes any sense. So here, we'll just look out maybe to something like this. Sell that's short of 20 delta. You end up with a structure a bit like this. You can tinker with it a little bit if you want a slight standstill credit. You could bump the put up or bring the call side in. But, these wing options are probably going to come in a little bit faster. So instantaneously, this is kind of like a soft upside exposure with the downside risk that you end up owning the underlying, at a discount to the current price of almost 10%, which sort of gets us basically to that from whence it broke out, if you will. FinWest, aloha. I'm back in the U.S. Good to be with you when the sun is out for a change. Well, welcome back. Stateside, you say aloha, so when you say you're back in the U.S., does that mean you're back in Hawaii, or are you on the mainland? I am back on the mainland myself. Joseph says, hi, Mike. Happy holiday. Hope you're enjoying our fine weather. So I am. I actually have had, I've had actually the windows and doors open. It's not really warm out here for those of you who are not in Northern California. But the weather here was pretty grim for a while. Very, very cold and very rainy. Luckily, I didn't have to suffer through all of that because I myself was in Hawaii for a week. But back from that, and the weather actually here is quite nice. Sunny and very pleasant. And FinWest is in Honolulu. Very good. Well, enjoy. That's where I was only a couple weeks ago. That weather was nicer than ours. And, it's interesting, too, because, for those of you who've been, I happen to like it a little warmer than my wife does. So if it's, in the 80s, low 80s, and sunny, that's absolutely perfect. My wife tends to think that if it's over 75 degrees, it's hot. We ended up going for a hike, but we started at a much higher elevation. And I noticed that it was probably, solidly 15 degrees cooler at elevation in Hawaii than it was down by the beach. So, very nice. He said, I'm bummed. I missed treating you to a Mai Tai. Well, it's interesting that you mentioned that. My wife was going to different places, and she was sampling the Mai Tais. And I'm not much of a sweet cocktail person myself. The Mai Tai at the Halekulani, which for those of you unfamiliar with Waikiki, there's a couple of the older hotels there that date back to the early 1900s. That and the Surf Rider, and I forgot what the other one is. These are some of the older sort of grand hotels that line the beach there, but they had a Mai Tai there. She thought it was a bit too tart for her. That actually is more my preference. A lot of fresh squeezed lime juice in that. So a little bit less sweet is kind of my preference. But if and when the next time we are there, I'd be very happy to hang out by the beach and enjoy a cocktail with you. So in the meantime, raise a glass and enjoy your day off and time on the islands. Okay, so let's take a look here. Can you look at Klarna and comment whether you think this is investable or speculation? So let's just start. I won't even pull up a chart. We're just going to look at the financials first of all and see what we think of that. Okay, so we've got very nice, rapid revenue growth. When are they going to be reporting? So we'll see what the last... So they're going to report right before Valentine's Day. February 13th is their expected report date. Street is looking for 25% year-on-year revenue growth to $3.5 billion. That is good. They are looking for revenue growth appreciation year-on-year from 25 to 26 to close to 30%. And expanding gross profit margins to nearly 41%. That is good. Now, here, let's take a look. Let's just distill this to quarters because I want to see when are they expected to become profitable. So they're expected to have their first quarterly profit in the second quarter of this year. But what is also interesting is take a look at this. Look at this number here. So last year, 2.165 billion in EBITDA. So we're looking at, this is kind of these are the numbers that I think are kind of interesting right here. Free cash flow, because remember, I mean, earnings aren't everything when trying to assess what a company is going to be worth. When you buy into a business, you're trying to discount the future value of the business to the present day. And arguably the best example of how earnings are not necessarily the best way to look at a company is Amazon. And in Amazon's case, that was a business that didn't really see much by way of earnings for a long time because it was absolutely in growth mode. And a lot of people who were evaluating the business were taking a look at, okay, what are they in? Is that growing? Do they have the ability to turn on the earnings spigot or switch, if you will, if they need or want to? And what are they doing with their growth? In Amazon's case, they were absolutely just investing in it. So, as I look at this and I say, okay, well, we're going to find out very shortly what their free cash flow was for this year and, whether they're on target for this this was how EBITDA, by the way, was how they, a lot of people who are looking at Amazon tried to value the business. And it's trading enterprise value at this point is 10 times next year's EBITDA, right? So, and I'm looking at the enterprise value to EBITDA because this is a company that has a big bit of net cash on the balance sheet, as you can see here. So the market capitalization is just shy of $11 billion, but that's because they've got all this cash, right? So they have big cash on the balance sheet. And what's the return? This is actually something that you think about even with Berkshire, obviously not a comparable business, but just in terms of looking at their balance sheet, and you say, okay, well, what is the company's earnings? And if you look at the earnings to mark, their earnings relative to the value of the business, you'd say, well, it doesn't seem all that great. But if you strip the cash out, it looks a little bit more interesting. But then you actually also have to take out the interest income because their cash balance is so huge. And so and then you say, okay, well, what are their operating earnings X cash is maybe the way I would look at that business. And then I think about the management's ability to deploy cash effectively in that case. So here, I would suggest that it does appear to be investable from that standpoint. So let's just take a look at, now we'll take a look at the price action and see what the technicals give us. Very much a mixed bag on an intermediate basis, it would seem. The two best performing technical indicators aren't overly enthusiastic here. Let's take a look and see whether it could be rounding the bend. I don't know that we have enough of an operating history to make that determination. This is one of those circumstances where I think most technical analysts would say we just don't have enough of an operating history to make a determination. Here's a question. We were just talking about Amazon. Will Saks Fifth Avenue bankruptcy have a significant impact on Amazon's stock price? They invested $456 million. And with the pending bankruptcy, what can we expect to happen short term? It's not really material for Amazon. That's the short version. I mean, it's likely a hit, to be sure, but we're talking at this point about even if their investment goes to zero. This is a $2.5 trillion company, and we're talking about a $456 million investment. So that's not really all that big. In other words, if somebody who's worth $2.5 million spent $450 on dinner, how much is their life going to change if the dinner turns out to be crap? It's not. It's like it's completely different orders of magnitude. It's immaterial. Look at the company's free cash flow for this year, and that's net of $143 billion in capex. We're looking at north of $41 billion in free cash flow, right? So that's 1%. It's not. It's nothing, really. Monday morning quarterback. Halekulani is a very classic place for good, strong Mai Tais. I'm going to tell you, if you go to Waikiki Beach, and even if you're not staying at the Halekulani, which is a very nice hotel, by the way, it's not a bad place to stay. Not an inexpensive one either, though. Very good place to watch the sunset. And a very nice bar out there. What is it called? Earl's. And I had a cocktail there. I think it was the Royal Hawaiian. Yes, that's right. That was the other one I didn't mention. It's right down the beach. Is it table 97? It was Hemingway's favored table at Earl's Bar, and they had a cocktail. I think it was called the Table 97. I'm going to look that up just so I can be sure. So the Table 97. Yes, Table 97. That was the cocktail that I had, and wow, was that good. That's really good. So Earl's Bar, good place to hang out and watch the sunset in Waikiki if you're ever there. They have some very nice appetizers. Again, it's not cheap, but how often do you go? Probably not that often. So a good spot for sure. And if I ever find myself there, and it seems like a few of you do find your way over there, that's probably more common for those of us that live on the West Coast. If you're on the East Coast, I don't know, maybe you head down to the Caribbean or something. But very easy to get to, well, relatively, for a multi-thousand-mile trip, relatively easy to get to Hawaii from here. So that's the deal with Klarna, and that's the cocktail I recommend at Earl's if you go to the Halekulani, table 97, which was so named. It's named after Ernest Hemingway's favorite table at that place. So let's see here. Mike, GE reports earnings this week, and GE Vernova reports later this month. I like both companies for continued growth. I prefer selling put credit spreads. What would you recommend for the next 2 to 4 weeks? So did I put that on screen? Let's make sure that I do. Okay, good. And actually, I just realized I need to realize now, with the benefit of hindsight, that I didn't keep this screen where I could see it. So I actually knew what was going on. So, this is an interesting one. GE, it does seem like they have well and completely turned the bend from all of the GE financial shenanigans. So let's look at GE first. Good numbers here. Had a solid bit of performance for last year and for the first 3 quarters of this year. 8% year-on-year anticipated top-line revenue growth. $8 billion in anticipated free cash flow for next year, which I'll just use round numbers. That's not bad. I'm going to round that up to 390. So what are we getting for free cash flow growth? 8,000 over... this is rounding down. 10% free cash flow growth. Not bad. It's not terribly cheap, though, is it? Not a cheap stock. I wouldn't think of this as being a real bargain. I mean, their operating performance looks very solid. So that's the good news. But it's not hugely cheap. So this is sort of its own historic 5-year range. And we can see that on an enterprise value to EBITDA basis, which is what we were just looking at, by the way, for the other company, it is a little bit above its own historical range. And here's something else, if you haven't seen this before. So if you price the stock at its historical multiple on an EV/EBITDA basis, it would be 272. It's trading 325. We'll leave price to book alone. But if we were looking at it enterprise value to revenues, I'm not saying that's a good way to think about it, but you can see it'd be a little bit lower. So it's very fully valued, is what I would say. Again, if you own it, especially if you're in a high tax area, am I saying dump it here because it's trading richer than it normally would? The company is growing. It's got good free cash flow growth. I'm not normally in favor of just saying, okay, I would dump, but it does feel, fully priced. I'll refer to it that way. And as you pointed out, got earnings coming up this week. It is this week, right? 19th. Yeah, so Thursday. Yeah, that's right. 4.8% implied move. That's what it looks like. So, yeah, I mean, it's fine. I might, I'd probably just sit tight if you own the stock. If you're thinking about selling put credit spreads, let's take a look and see whether there's any put credit spread. You know, the thing about selling put credit spreads is this is a little bit like doing buy rights going into earnings. I'm kind of more in favor of that if I see a situation where a stock, the options are clearly much higher price than I might otherwise anticipate. And that is not necessarily what I see here. 4.8% implied move versus just under a 4% average move. Seems reasonably priced to me. But, you know, if you're inclined, I suppose you could sell some put credit spreads. Let's see what we've got. And let's go to see what that's going to look like if we went to. Let's see if it takes the implied move to the downside. That gets us to 312. I might want to do something like a 310. And what do we got here? What about this one? What do we got? $2.80 is the max gain on a $10 wide put spread. %20 on 310, 305. Now, I will make the following point, which is that if you sold this put spread and the news came out and the stock goes down to that lower strike, it's not going to go to $5. They're still going to, in fact, if it dropped to 305, that is still going to be, there's still going to be probably 40% of the distance between the strikes would be the effective value of that call spread. Okay, so it's going to be two, you know, you're basically going to sell it for one, it'll go to 3. So instantaneously, it would really have to plummet well below 305. And 310 is just outside of the bottom end of the implied move to the downside, right, which is about 312. So if it was going to make that implied move to the downside, you know, that's what you're going to get at. That it should be inside of that expected move about 60% of the time. So the expected move is not the same as the standard deviation. It's about 80% of it. So just something to think about there. But that's, yeah, I mean, that's okay. Am I super excited about it? You know, like I said, just because of the valuation here, it's not like I'm looking at that and saying, okay, well, you know, I think it's a complete bargain at this price. It's a good company, but it's fully valued. Fast forward to GE Vernova, not Veranova, Vernova. And now we're looking at, just shows you how strong both of these stocks have been. Same thing here. Excellent operating results, good management, but not terribly cheap once again. Right? So, you know, at its historical valuations over the last, let's call it 5 years, wait for this table to update, it's definitely towards the upper end of the range. I mean, this is one of those situations where, uh, like I said, same thing with GE itself. If you own it, not advising that you necessarily sell it, but it's trading at a significant premium um, to the broad market, and it's growing faster as well. But it's not like it's trading at I mean, think about what the price earnings growth ratio is here. That's, I guess, one of the ways that you might think about it. Although actually, this thing is, they really anticipating earning. Why is the earnings growth this pronounced? I mean, I guess, look, this is really I think what is trying to justify the multiples. Trading 50 times earnings, and the company had very low margins recently. Are these margins sustainable? Let's take a look at this a slightly different way. Maybe this would be another way to think about it. So let's take a look at sort of their closest competitors and see what, these margins, are they really, beyond the pale relative to other businesses in their space. So just out of curiosity, I mean, not that a European company's operating efficiency is comparable necessarily, but let's just see what kind of margins they've been able to accomplish. 11%, pretty consistently. And 11% margins over here would translate to, and I would expect them to do, all right, so that actually seems believable, right? So they're basically saying that, that their margins are going to, basically reach the level that Siemens did. Okay, so with solid growth on the top line, is that achievable? So, if you're watching what I'm doing here, if you have a turnaround story, the recent operating performance isn't necessarily the guideline that I like to use. If I think I've got a business that's in a competitive space with a solid management, and there is a bit of a turnaround, and look, GE was this conglomerate. It got totally sideways because of GE Financial. They broke the company up, focusing on core business. Now you can say, okay, well, properly operated, how should that business perform, and what is the expectation? And, the expectation here is that, they are going to, that their margins are going to converge on, some of the other better operated businesses in the space. That gets us, I'm not going to say it's optimistic, but now we have a better understanding of where those numbers come from. So, with that in mind, do we think that the company should be trading around 23, 24 times earnings in a couple of years with 10, 12, 14% top line growth? Yeah, okay. I'll go along with that. That's reasonable. Let's take a look at how the options are priced here. High vol. And they're going to be reporting in a week. Only 5.25% implied move. That seems almost in some ways surprisingly low. I'd probably look at something like a call spread risky in here. Short strike here. Let's see how that works. I don't know if that prices out well. The implied move is a little bit less than I would have expected. So again, you expect a higher implied move for companies that have a less of a track record in terms of their operating history. That's not to say that the sub business did not, because it was a unit in the larger conglomerate for the longest time. But there's not a huge, there's still less of an operating history for these as standalone businesses. Let's take a look. All right, let's go out. We can go to the weeklies once again. See what we get. Let's use some nice round numbers. Go to it's approximately 50 delta call here. See what this looks like. I'm willing to bump this delta up just a bit because I think, where was that? Where's that lower strike that I had chosen? 550, huh? I don't think we're going to be able to get that far down. Yeah, you're probably going to have to lay out some premium. But yeah, something like this, I think. And again, this is one of those situations where, once we kind of divine what it is that is causing the multiple right now to seem as high as it does, it begins to make a little bit of sense. Is that you just don't have, all of these units, they spun out, and now they're basically spinning up to full speed, if you will. That's kind of the way I like to think about it. The underlying businesses are strong. Like I said, I think the management for GE's business, that now broken up, GE's respective business units are also very strong. And I don't have any reason to doubt that they should be able to accomplish similar operating results to their closest competitors. And in that context, the valuation seems reasonable if we think they're going to fulfill that. And would I rather be in the U.S. Business like a GEV versus a Siemens? Yeah, I would say so. But you are paying a premium for it, not immaterial premium. We'll just take a quick peek. So it's just to remind everybody, you can always rewind the video and take a look at it there too. But these things are trading at big premiums. But this is on kind of a trailing basis because we're sort of going through this ramp period. And we're going through this really slow Bloomberg period. Yeah, so I mean, you can see here, on a price to forward earnings basis, Siemens is at 32 times. And Vernova, GE Vernova, is at 50 in round numbers. So, you're paying 50% more on the forward numbers for GE Vernova. But, all else equal, I'd rather be in the U.S. So, I guess that's reasonable. So hopefully that helps. Yeah, let's take a look here. With the turmoil in the Caribbean, would puts on cruise lines like Carnival be a good idea? I don't think they're doing great either, and at the high. So this is an interesting one. We got Netflix in here. We definitely should get to that. So here's my thing. So Carnival Cruise is, from a demographic perspective, they are at the lower end of the range. So they They have a lower end demographic than Royal Caribbean does. They have a lower end demographic than why is the name escaping me? They do those river cruises in Europe. Anyway, so Norwegian, Royal Caribbean are higher end than Carnival is. And one of the things that we've seen in consumer data lately is that, and this comes as a surprise to none of you, I'm sure, the upper end demographics of consumer spending is quite strong. Actually, I saw that when I was in Hawaii. It was like the old days when I think about what Christmas shopping used to look like, that you almost dreaded going to the mall because it was absolute madness. Viking, thank you, Joseph. That's right. So Carnival skews a little bit towards the lower end, and because of that, I would not favor it. First of all, it's not on my radar. Here, you can see sort of on the top line, growth is expected to slow. Next year's growth is actually less than the rate of GDP, the most recent GDP growth, but it's certainly lower than the real rate of inflation. So in real terms, this thing is actually not expected to grow year on year. Some of these entities took on huge amounts of debt as they had to during the pandemic. Carnival is among these. It's kind of been resolving, but just take a look at this. So this was the net debt at the end of 2019. It almost tripled by the end of 2020 due to the pandemic, which, look, capital intensive business, revenues go to zero. That's what happens. I think they have managed it okay since then. But yeah, this one just doesn't excite me. I don't know why one would reach out at this point, other than being tempted in by what Charlie Munger used to describe as the cigar butt strategy. The cigar butt strategy being that, you try to see, you're looking for the cheap stocks. And this one's cheap. It's only trading at, what do we got here? 11.4 times forward. And decent free cash flow yield. So, and actually decent free cash flow is anticipated relative to their enterprise value. Yeah, so it's, but I just don't know that I would be interested in going towards that end of the demo. So we'll look at Royal Caribbean, which I expect to trade at a premium, material premium, because it is skewing higher. And sure enough, for the reasons I just described, 17.6 times earnings. So significantly more expensive, but much better growth. And much better resilience. That's the other thing, is that when we look at these numbers and you say to yourself, okay, well, I could get Caribbean at a 40% discount relative to Royal. Well, is it a 40% discount? It's the most stressed or stretched part of the consumer spectrum, if you will. So what that tells me is that forecast is probably a lot looser than the forecast for those that can well afford it. So if I had to be in the space, Royal is trading at a premium, but I would sooner be in, I think it's better to be in best of breed. How about we put it that way? I would just prefer it. Now, there's one other thing I should say, which is that I'm making all of these comments as somebody who does not consume these products. If somebody said, hey, we're going to send you on a Carnival Cruise Line trip for a week for free, I would go. It does not appeal to me in the least. From what I've seen, I see all these people shoulder to shoulder around some small swimming pool and lining up at the buffet. I have no interest in that. And so I say this to you not because I hold it against people who like to go cruising. I have spoken to people who say, oh, it's terrific and we love it, this and that. There's something for everybody. I say it only because my comments are almost inevitably going to be negatively influenced by the fact that I just don't get the appeal. Because it doesn't happen to appeal to me. So between Royal and Carnival, I would tick the box for Royal, and Carnival is it's a cheap stock. And if you want, but it's it's just like Charlie Munger said, it is about as appealing to me as picking up a cigarette, a cigar butt to see if it's got a couple more tokes in it. Like, I have no interest in that. None whatsoever. But I'm, very happy that some people enjoy them. Good for them. And maybe I'm just being too close-minded about it. Okay. Let's see here. Michael Anthony, you are asking about Up FinTech Holdings. What is this thing? I don't know this company. You must, this. I'm curious, Michael Anthony. On a boat for a week can make you sick. Sick, you say? Yeah. Well, I've heard horror stories about people floating around on those things, and then all kinds of nasty stuff happens. But like I said, there are plenty of people who enjoy them, and good for them. I am curious, Michael Anthony. This came up because I'm wondering how you're screening for stocks, because you have a tendency to pull up stocks that I have never heard of. Granted, by virtue of what we do on the professional side, companies of this size are just generally not going to be on our radar, because there's a kind of a liquidity consideration. But I am a little bit curious about your screening process, because you always find, I have a feeling that you are screening stocks globally, or maybe you're just there is a US ADR, but that you're screening stocks based on price to earnings. So a simple yes, no, I'd be kind of curious, but I just get the sense that that's what's going on. And the reason I bring this up is because I don't screen on price to earnings. I screen on revenue growth. I screen on free cash flow, and I screen on positive versus negative earnings revisions. So basically, I'm just looking at the numbers. Like, is the top line growing at a good rate? Is the bottom line growing at a good rate? Are margins expanding? This kind of thing. And then I start looking at the valuation afterwards. I mean, you guys will notice, like, what is the first thing I do? I'll just take a look at the financials. So the kind of stuff that you're seeing on this screen right here, I'm looking for, and you have some decent numbers in here, it should be said, right? So do you have revenue growth? You have very good revenue growth. You had 9.1% in full year 2023 versus 22, and then that accelerated. Then it accelerated again. However, next year's numbers, much, much lower. So this would be a little bit of a worrisome sign to me when I start seeing the top line growth figures decelerate such that they are not hitting those thresholds that I typically have. This one, even if all I was doing was screening the entire investable universe for top line growth numbers, this one actually would have fallen off, and it would have fallen off because next year's revenue growth numbers are expected to be, quite muted. 2% is, not that great. Stock is cheap though, as we can see. I mean, that is quite a cheap number. So that is a positive. Let's take a look at what the technicals give us in this one. Oof. It's below the 200, huh? That's, you know, the old saw. Nothing good happens below the long-term moving averages. I would want to see it break out of that somewhat concretely as well. I mean, there are a lot of people. There are a lot of folks who make money by buying cheap stocks, and this is a cheap stock. I'm not so happy about the way that chart looks, and I don't like the deceleration on the top line. So it wouldn't show up in my portfolio, I guess. That's and again, you know, look, there are a lot of exceptional investors out there. You know, I haven't approached the returns for those approaches tested through time look pretty good. You will sometimes find yourself not buying stocks that might be compelling for other types of investors, but that's just not going to. That one doesn't land on my buy list. But you know, single digit price to earnings. You know, buying something really, really cheaply gives you a margin of safety. If I don't know if any of you have read that book, by the way, Margin of Safety. It's a quick read. You're not going to want to buy a hard copy of it. I read it online because it's out of print. But you know, basically, the idea in Margin of Safety is that if you buy something at a really, really cheap valuation, then you know the chances of you losing anything meaningful with it are very slight. But I would not buy this because it's below the long-term moving average. I would not buy this because the revenue growth anticipated for next year isn't there. And I will admit that sometimes, you know, I miss good opportunities, and at 8 times earnings, maybe this one is one. Just it's not for me. All right. So with that, this is a day off. The markets are closed, but I did say I was going to be here. And so here we are. And I always enjoy sort of sharing my thoughts because it helps crystallize my thinking. And Michael Anthony, for what it's worth, you know, you're bringing up stocks. And I appreciate this. Every single time you guys do this, and you get me looking at something that I hadn't looked at, it at least gets, you know, what few gears remain in my head whirring. And it's worth looking at these things. Even if you look at a stock and you decide it isn't for me, that doesn't mean it wasn't worth taking a look at it. So it is true for this one. Not a name I had looked at before. I might look into it a little bit more because I'm just curious about what it is that they do. But it wouldn't have landed on my screens. So I'm just going to put this up there. I find the company looking at earnings, one company other than Tiger that bought a little last week, saying they support at 910, which is where it is now. They look for undervalued. Well, I mean, look, it's a cheap valuation, and you know, always good to look at things from different directions, including just looking at cheap stocks. So with that, because the production staff also had other things that they had to get on with after the hour's up, and I've gone over my full hour, I'm going to let them go, and I'm going to let you guys go too. But as always, thank you for your time and attention. Thanks for watching, and we'll see you soon.